Hey there, got some exciting news for you. The Blockworks Podcast Network is hiring 2 podcast hosts for an upcoming show called Lightspeed. The vision for Lightspeed is an exploration into crypto from the angles of builders and engineers who are designing for scale and whose goal is to bring the next billion users into digital assets. If this sounds like you and you want to join me on the Blockworks Podcast Network, go to blockworks.co/careers. Links in the description. Thanks. I am joined by Martien Lubberink, professor at the Victoria University of Wellington. Martien is an expert on the topic of regulatory bank capital, a topic which I feel is undercovered broadly in the world, and specifically, on Forward Guidance, we have not been covering this, so I'm really glad that we have an expert with us to break down this complex issue. Professor, welcome to Forward Guidance. How are you doing?
I'm fine, thank you very much. Thank you for hosting me.
It's my pleasure. Professor, I want to learn what bank regulatory capital is. I want to explore it, in some depth, have it apply it to the recent banking crisis in the United States, the fall of Silicon Valley Bank. What regulatory capital, what went wrong there? Explore Credit Suisse, the tier one bonds. What went on there? Talk about the Reserve Bank of New Zealand, which just raised by 50 basis points where you are located. That was a little bit of surprise to us, at least. But to start off, tell us, once you got your PhD and you went to the Central Bank of the Netherlands, that's where you really started to work full time on regulatory bank capital. Take us back to there. And then you can introduce what the concept is. Let's go back.
Okay, it's actually a bit of a longer story, but I worked after my PhD that I obtained in Holland. I thought about moving to Lancaster University in the UK, and after a couple of years, I thought to take a sabbatical for a year, and I ended up in 2008, 7-8, at the UNC Chapel Hill, which is a wonderful place. And I enjoyed my sabbatical over there. And then suddenly I noticed that banks in the US were toppling, and there were problems with Bear Stearns and other Washington WAMU, was it?
Yep.
They were all sort of a bit in problems. And then I thought, okay, so what's going on here? So I started looking into banks and bank debt in particular. And then at some point, I think in February, March, I thought the sabbatical will end, and what's now? Shall I stay in the US, or shall I go to back to the UK or to Holland, where my parents live? And I thought, and then suddenly I saw an advert from the central bank in Holland that they had a position there for somebody who knew something about bank accounting. So I applied, and the interview was kind of interesting because I had a video interview with my future managers, and I pointed out that banks in the US were shaky at that moment, and it was March 2008. And so I asked them, is it safe? And is this only a US problem, or I can move to Holland, but it's not really funny if I land in or if I get a job in Holland and then banks in Holland start toppling. Because that will probably lead to a crisis and so forth. So no, they said, the managers were adamant, and they were very convinced that this was only a US problem. And I said, well, if that's the case, then what prevents me from going back to Europe, and then in particular Holland, to get in touch again with my parents and see them more frequently and so forth. So they said it's only an American problem, and I arrived there in July 2008, and still it was kind of safe, but we all know that in September 2008, Lehman collapsed, and then it wasn't at all a U.S. problem in its own. So, and soon after, the regulators, the Basel Committee, and various other regulators started redefining capital, and I was part of the working groups at the Basel Committee and the European Banking Authority to redefine capital. So that focused my interest on capital alone, and as a result, I learned a lot about capital. And so after years, I think in 2013, I decided to take it a bit easier because it was hectic times, long working weeks, and a lot of stress, I think, also. So I decided to move to New Zealand, where I got a fantastic job offer, and since then I'm there.
Yeah, thank you for explaining that. What a journey! I mean, to join a central bank in July of 2008,
Yeah,
2 months later it's Lehman. That really is remarkable timing. And then in the U.S., the banking crisis kind of ended. 2009, 2010, a lot of failures, but it was restored. Whereas in Europe, the sort of the stress continued. I imagine. So,
yeah.
Martin, I want to ask you. I've heard this said that, Bear Stearns, Lehman Brothers, they were levered 30 to 1, 40 to 1. And now, this is pre great financial crisis, they failed. Now, Bear Stearns didn't fail, it was taken over. Now banks are only levered 10 to 1. What does that mean?
Well, it means that they're much more resilient than they were before. So that's a good thing. And I think that's one of the achievements of the Basel Committee and the global rules on banking. The leverage has gone less levered, and that's a good thing. Across the board, I think worldwide, and also if you look at European banks in particular, they are much more resilient because of these higher requirements. So that's not a problem. I think you have to be aware of that there's always the possibility of a run or mismanagement. And that I think hit in particular SVB Bank and also Credit Suisse. The one thing that people may not understand very well or may have not seen on the radar, the banking or the global financial crisis, as a result of that, a lot of work was done on liquidity rules and capital rules. So they addressed credit risk and liquidity risk. And so credit risk and liquidity risk are now more or less sorted in terms of regulations. But what is kind of the more problematic one is operational risk. And that can be operational risks are there's a high variety in the types of risks that contribute to operational risk. That could be fraud, or that could be money laundering, mismanagement, and so forth. So it's far more difficult to manage or to regulate operational risk. In these cases, like SVB was probably also a case of operational risk where things were just not working fine in terms of governance, in terms of management, in terms of the interaction between these supervisors and bank management and so forth. So it was more a combination of poor management, which then led to a very poorly diversified set of depositors who were hot depositors and could run quickly. That combined with heavy investment in a single or almost single asset type, it's it's almost unfathomable, unthinkable of what all the things that contributed to the demise of SVB. But the thing is, I think that's important is it was well capitalized, but as we've seen with a couple of bank failures, capital is not the end of it. It's not everything, and you have to be aware of other things like liquidity, and in this case or these cases like Credit Suisse and SVB, that operational risk is still something to be looked after.
Can you break down what is bank capital? When people say banks are well capitalized, what do they mean?
Oh, bank capital is basically it's equity, and that's the difference between the assets and the liabilities. So, and there's a couple of adjustments. So there's a slight difference between equity and bank capital, but it's basically the difference between the assets on the left-hand side of the balance sheet and the liabilities on the right-hand side of the balance sheet. So that's the gap. And as long as you have more assets, or if the value of your assets are higher than your liabilities, you're in business. And so that is more or less, the difference between assets and liabilities. That's bank equity, and it should absorb losses. So that's the whole thing. If these assets start deteriorating in value, that means that the bank is running losses, and then equity should absorb these losses. So the concept of loss absorption is very important in bank capital. That's I think the most important reason why we have bank capital. It's there to absorb losses.
Right. But the amount of bank capital, even if it's still large, it can be wiped out completely if the loss is exceeded and then the bank is mark to market insolvent. That's what happened with Silicon Valley. As you say,
Yeah,
it loaded up on very interest rate, long duration securities, treasuries, but mainly agency mortgage backed securities,
yeah,
which lost an immense amount of value as the Federal Reserve rose interest rates, and they
yeah.
were negatively convex. So they lost more and more money, and it wiped out the equity. So how is it that you said Silicon Valley Bank was well capitalized, but then I guess the losses were just too much. So what went wrong there? And I could see on liquidity and credit, you could make an argument. Well, agency mortgage-backed securities, very low credit risk, guarantee of U.S. government, and then liquidity, you can buy and sell them at will. So where were the lackings of regulation, and particularly interest rate risk?
So the thing was, the interest rate risk is lowers the value of a lot of the assets. However, I think there was a bit of an accounting trick that it was playing up here with SVB. Most of the assets that the bank had were at the original 100% value. And that's all fine for many banks. They have these held to maturity assets, which are valued at cost, and they keep their value forever, 100% in the books. That's not a problem if the bank is well run, even though the market value of these assets are lower. In the end, most banks will be able to pay back these, or they get 100% for these assets anyway at some point in time. However, you may have at some point in time, like now, because of interest rate risk, that these assets market values are a bit lower than their original values. And so with the increasing interest rates, the market values of the assets that SVB held were dropping, and that should affect equity if you had full mark-to-market accounting. However, because of the accounting, we see that the effects on equity the losses were kind of hidden, and as a result didn't affect the equity value of SVB. Now the problem is that, or the point here is that if the bank is well led and ticks all the boxes with respect to governance and diversifying its depositor base and investing in other assets, if that's all fine and well, then there would not really be a problem at SVB. The problem ensued shortly after everybody discovered that these asset values of the long-dated investments had a low market value, and then depositors started running and forced SVB to sell these assets which had a book value of 100%, but they were forced to sell them at a very low price, and that led to losses. And as a result of these losses, equity was stressed, and these losses were imposed on the equity value, and as a result, the equity ratio, capital ratios of SVB dropped very quickly. So the thing is, yes, temporarily you have these the values of some of these long-dated instruments or investments, they can diverge because lower market values. But at the end of the term, once these bonds are paid back or redeemed, the value should be back to 100%. And then you would never have a problem. The problem was that SVB was forced to sell them during midtime or during the tenure of these of the instruments, and then had to crystallize the losses, which then affected the equity negatively. The thing is, maybe SVB would have been less problematic if they had held more capital, but if you just do the maths, more capital would probably not solve the problem of SVB in the end, because the massive losses on the securities were so high that even a higher capital ratio would not help. But for sure, if they had a lower capital ratio, like pre-Basel or pre-GFC ratios, then the problems would probably occur way faster.
My next question is it fair to say that Silicon Valley Bank had a very extreme mismatch in the duration of its assets and liabilities?
Yeah, well, that's kind of obvious. It's almost like how to show or how to not run a bank. We all know that banks invest in long maturity assets, mortgages of 30 years or 10 years, and they borrow short. And there's a whole lot of tools there to prevent that mismatch from wreaking havoc with the bank, like hedges or diversifying depositors or diversifying assets and so forth. So in order to make that fragile banking model work with long assets and short liabilities, there's many supporting tools to prevent the bank from collapsing like SVB did. And yet, what we know is that SVB hardly used any of these tools. Like, for example, if you look at New Zealand banks, they're exposed also to interest rate risk, but they have hedged all these risks using swaps. And so the problems are now, I think, transferred off balance sheet to central counterparties who absorb these risks now. So, a thing like insuring yourself against the loss of value, which, by the way, most homeowners would do with their own mortgage as well, just buy insurance. That was just, I think, not done by SVB. And then other things happen as well. So as a result, of just a very simple banking model, which wasn't dealing with all the tools, or which didn't incorporate the tools that you should use to deal with the fragile balance sheet that it had. The result of that was just a quick demise.
Yes, it's quite clear that they had a asset liability duration mismatch. What
Sure.
I've been trying to find out, Professor, for a long time, and I have a theory I want to share, is how the Silicon Valley Bank management thought that they were matched. And I think that they made assumptions about their deposit base
Yeah.
and about the duration of their non-maturity deposits, about how long they would stay there. They would,
Yeah.
it'd stay for an average of 4 years, 6 years, 7 years. I'm just making numbers up here, and it turned out to be wrong. Yes, demand deposits can be called on in the duration of 1 day. So 1/365th is the duration if there's a bank run, but money stays there. Money tends to stay there. Money tends to increase if venture
Yeah.
capital
Yeah.
funding goes up. So is that the way that is that how Silicon Valley Bank management justified the interest rate risk themselves? They said, "Oh, we're hedged because these deposits have a duration of 7 years," and they actually had a duration of 1 day.
It seems to be that that was the case. They relied on the stickiness of deposits, which then more or less cancels out the downward trajectory of prices when interest rates go up. So if interest rates go up, then the asset values, or the values of the investment of SVB would go down, but that would be compensated by the sticky depositors, because it's easier to make money off for a bank in high interest times. And given that depositors are sticky, that creates an additional profit for the bank then. So the losses on the assets are then compensated by the stickiness of depositors. However, and that is one of the things that most regulators probably are thinking about, is what do we assume now with respect to the stickiness of depositors? Because what we've seen here is that they were hot depositors who quickly ran like in hours instead of in days. And that is something I think regulators are worried about, given that social media and your app will allow you to very quickly move your money to a different bank. And so that's something that will or probably will be addressed in future regulations.
Thank you. You said earlier that the New Zealand banks hedge, and all of the U.S. Globally systemically important banks have very sophisticated hedging programs. The degree to which those hedges offset the losses, unrealized losses on HTM portfolios, that's another side. But my question for you is, what does a hedge mean if you buy a 10-year U.S. Treasury? The only risk you're really taking, right, is interest rate risk. So if you enter into a swap to hedge that risk, now you have swap spread risk, and you're long someone thinks short another. Like there's a saying of the only perfect hedge is in a Japanese garden. Like if you want to hedge your Apple holdings by selling S&P 500 futures, it's an imperfect hedge. And I like what income do you make as a bank if you're treasuries but you're short swap spreads? I mean, that it's because the only risk you're taking is interest rate risk. So
What they do is they hedge it, and so they transfer the risk to other parties off balance, and that's what we've seen happening. In particular, I think there were some cases in Holland and New Zealand and in the UK where just before the crisis, farmers were locked into a swap to protect them from interest rates going up. It turned out that these interest rates went down, so a lot of farmers and SME or small and medium-sized firms were more or less painted into a corner by the swaps that they purchased. The banks, they go free because they're intermediating the swaps. They, on the one hand, they sell swaps to their borrowers. On the other hand, they transfer, the counterparties then are pension funds and insurance, or insurance companies and pension funds that are at the other side of the swap. And as a result, all the risks are off balance. And I think that the banks then keep for themselves the fee of the swap arrangement, or the swap fee.
right, in that instance where a bank is facilitating a swap, and that would be an investment bank doing that. But let's say if Silicon Valley Bank, they had a huge influx of deposits, their deposits basically tripled in a little over a year, maybe two years, and
Yeah.
with that they bought securities that had interest rate risk, 10-year treasuries,
Sure.
a mortgage-backed security. By hedging those risks, if I buy a 10-year treasury and then hedge it, what am I earning there? You get what I'm saying? Why not just hold it in cash? It's like buying Apple and then selling Apple.
Oh yeah, okay, yeah.
Yeah.
So yeah, well that's gosh, yeah, that's a good question. So um that's actually beyond my 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 expertise actually. Yeah, like how do they make money then? Because then if everything's hedged, the banking aspect of the transaction then disappears, because then it's not really banking any longer. If you move all the risk off your balance sheet, the only thing that you then have is income from, what is it, fees or so. Yes, you're right. So probably there will be an imperfection in the hedges. Um, and the other thing is, the other question that is that may be a bit of an issue is, do the central counterparties or the center, what is it, the CCPs, will they be sufficiently well capitalized to deal with in case there's a demand on the protection of these hedges? But yeah, it's a bit beyond my field of in.
So bank capital couldn't have saved Silicon Valley Bank if there was more stringent capital rules, or what do you think?
I think there's a limit to what bank capital can protect a bank. This case was clearly the result of depositors running and then forcing the bank to sell these held to maturity assets, and as a result of that, they had to sell assets that had a low value, that had a high book value for a very low price, which then resulted in losses and took away the equity. So yeah, if you have an unpredictable run, and runs are unpredictable, they can wreak havoc. And so good risk management should be prepared for that. And as I said, there's so many tools that banks can use to do that. And yet, if I look at my understanding of SVB is that they ignore that, because in the end, I think, and that's probably back to your previous question, it is tempting to make money like that and then not protect. And I mean, you can overinsure, but then you pay a lot of premiums for insurance, and that takes away part of the profits that you want to make.
Yes, and when I learned just about how the duration of non-maturity deposits, how that plays such a key role in the duration of their liabilities, it's an assumption that you have no idea. The banks have no idea there's going to be a bank run, or the duration could be 20, it could be 1 day, and it's just kind of a little scary.
But it's also based on trust, so
Yeah.
you have, so on the one hand, it's a risky setup if you if you lend long and borrow short. Of course, there's always risks, and the best thing a bank can do, and which many banks do successfully, is to manage these risks. And there's so many, as I said, there's regulatory tools, there's capital, there's hedges, there's derivatives, there's good management, there's good governance. All the tools are there to protect a bank from being exposed to the risk. But if you chop away if you just ignore all these tools, that may lead to the outcome that we've seen in Silicon Valley Bank. In a way, it's an exceptional situation. The case of Silicon Valley is probably exceptional.
Yes.
That said, it doesn't mean that it won't happen to other banks. In my case, what I learned from that is that bank runs, even with high capital, are possible. And also, you have to be aware of the fact that in this case, governance and operational risk played an important role. And that is one area, as I said before, that's an area that wasn't well covered after the global financial crisis, because operational risks are so diverse that it's very hard to model them. And the modeling in the Basel regulations on credit risk are, in a way, kind of primitive. They're, the capital requirements for operational risk are based on sales values, for example, or margins that are created in some business lines. Like the more margin you earn in business line X, the higher your requirement will be for operational risk. And so that doesn't really deal with operational risk like anti-money laundering, fraud, theft, fire, and all sorts of other things. So it's hard to model, and as a result, you will see that mistakes may happen because of the lack of knowledge about how operational risk works.
So, what are the tools that banks and bank regulators can use about interest rate risk? You talked about derivatives, so that's basically swaps. The one type of hedge. There's bank capital. What else? What are the other tools available?
Oh yeah, and the other one is just diversify your deposit base to make sure that you have diverse depositors and hopefully some sticky depositors. And on the other hand, also make sure that you don't have a large exposure on a single asset class. That's banking 101. Banks are very, they in our country we have 4 banks, and their main asset class is residential real estate, and so there's a high sensitivity of bank capital with respect to changes in the values of homes in New Zealand. So that's risky, and so therefore New Zealand banks have to hold high capital to protect themselves from anything that happens to a single asset class. But if you can diversify, or if a bank diversifies in various other asset classes, not solely focused on residential mortgages, but also other, like what is it, small and medium-sized firms, et cetera. If you diversify, then the risk of you running a loss will disappear, or will almost disappear in full.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world, and this year Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present, because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. What are the major ratios for bank capital? There's common equity tier 1, the supplementary leverage ratio. What are these? Why are they important? And name some other ones.
Well, I think the most important one is the one, the risk-weighted one. Well, it depends a bit on where you live. I think in Europe and in outside the US, the focus will be on common equity tier 1, which is the risk-weighted, which is capital of the highest quality, and then that is equity minus, for example, goodwill and other items that are deemed not to be very high quality equity. So it's core equity, and then divided by risk-weighted assets. That's your common equity tier 1 ratio. So you have high quality equity divided by risk-weighted assets. In the US, I think there's more focus on tier 1 or common equity tier 1 divided by total assets, which is the leverage ratio. That could be, I think, the supplementary leverage ratio. And so what these ratios do is they just they measure the amount of loss-absorbing capital, and then and the ratio is just to correct for the amount of risk. So the higher the risk, the higher risk-weighted assets or assets will be, the more capital you have to hold. So in the risk-weighted ratios, the risk-weighted assets will drive the demand, or drive the numerator to be higher. So a more risky bank will have to hold more equity, and that is to absorb more losses. And so you have common equity tier 1, which have become very popular after the financial crisis, and I think there's tier 1, which is equity plus hybrids, the ones that wreaked havoc on Credit Suisse, like additional tier 1. There's tier 2, which is another layer of capital which is meant to be used once the bank is gone concern. So that absorbs losses when the bank is bankrupt or in liquidation. And so these are the most important ones that I know. I mean,
Right.
But the big distinction is the common equity 1 divided by risk-weighted assets, that ratio, the CET1 ratio, versus the leverage ratio, which doesn't rely on risk-weighted assets, but on total assets instead.
Thanks. So if there's a common equity tier ratio of 10%, that means if it's $1 billion in assets, in risk-weighted assets, it'd have 100. Say $1 billion assets, it would have 100 million in equity.
Yeah. So it means that if you increase that from 1 to 2 billion, then that doubles more or less the required amount of capital that you hold against these assets.
Right. And so, folks listening, that may sound simple, but the level of risk-weighted assets itself is a very complicated equation, right? Because certain assets have certain risk weights, and
Yeah.
others have other risk weights.
Yeah.
Tell us about that.
So on average, about 70% of the total assets will be translated into risk-weighted assets. So your risk-weighted assets are about 2/3 of total assets. That's for most banks, a ballpark figure. So, but if you're more risky, if a bank has more risks, more risky assets, like in more risky industries, then you will see that the risk-weighted assets will increase. Cash, for example, has no risk, and as a result, cash will be given zero risk weight. SME firms, small and medium-sized firms, I think they have 100% risk weight, so they count.
Loans to them have 100%.
Yeah. So I'm talking about loans. So it depends a bit on the riskiness. Some assets have higher risk, some assets have lower risk. Residential mortgages have relatively low risk. It depends a bit on where you are and where you live, but I think in New Zealand it's about 35% risk weight assigned to residential mortgages. So it's no surprise that banks will invest in these low risk assets because they don't contribute a lot to the requirements. So the higher the weight, the more capital you have to hold. The lower the weight, the less capital you have to hold. And so banks will tend to move towards or invest into or lend to borrowers of a low risk type.
Right. But sometimes, rarely, there can be a difference between an asset that the regulators tell the banks has a low risk and an asset that actually is low risk. And that is where trouble can emerge. Take us back to Basel II. Is it true that banks could hold AAA rated paper that was basically collateralized by subprime mortgages at a somewhat low risk rate? And did that contribute to the great financial crisis?
Yeah, in a way it did. Like the AAA, because of the AAA rating, these assets were deemed to be safe, and as a result of that, they had lower risk weight. And as a result, means that banks had to hold less capital against that to protect themselves from the losses, which makes sense if these AAA ratings were right, then it all makes sense. But in this case, these AAA ratings, and we all saw the movie, what is it?
The Big Short.
The Big Short, and we read the book, and we know that there's discrepancies here. The other example is there. If you look at sovereign bonds, they have a very low risk weight, but then there's countries like Greece at some point in time that had very high risk attached to these sovereign bonds, and yet they were given a very low risk weight. So there can be discrepancies between the actual rate and the regulatory rate. So again, that's for risk management and for supervisors to be aware of, like, oh man, you're investing a lot of your capital or your money is going into investments into Greek sovereign bonds. Are you sure you're okay with that? That should be the question of the supervisor then to put to the bank who invests in these assets.
I feel like a lot of that sensitivity is paying attention to credit risk. Oh, a loan to a business, they might pay you back, they might not. So you should have a high risk rate. A loan to a government, aka a sovereign bond, that you're going to get paid back. Even in Greece, you're probably going to get paid back. But there's interest rate risk as well. What do risk weights look like for sovereign bonds? New Zealand, Europe, US, choose wherever you want. And do you have to hold? Is a 30-year treasury, 30-year sovereign bond? Does that have a higher risk weight than a 10-year? Does that have a higher than 5-year, a 2-year? Is there a in the same way that there's a gradation for credit risk? Is there a gradation for duration risk?
You caught me off guard on that one. So I think it's very tied towards countries, and whether it's OECD countries or not. But I'm not sure. Under Basel II rules, there may be if a bank can use its own modeling to determine risk weights, then probably maturity will factor in. So probably banks that are under IRB may be able to do that, but I'm not sure about the standardized approach, whether they can do that. But it would make sense.
Got it. Well, I feel like if you don't know, no one knows.
No, well, no, yeah. Well, it depends. My focus is very much on the numerator of the ratios, what goes into the denominator, like how risk weights are determined at a very detailed level. That's beyond my reach at the moment. But in general, I think what is the case is that many of these risk weights, they are low for asset classes that are deemed to be safe. The problem is that there can be divergences here, and there can be things like maturity, but that should be dealt with, I think, under market risk. And then there's in European banking regulation and worldwide, there's also what they call Pillar 2, which is an additional layer of capital which banks have to hold to deal with all sorts of risks that are not dealt with under the standard framework. So, for example, just to explain that, the CET1 ratio requirement, and that's about 7%. That requirement is what we call a Pillar 1 requirement, and then there's buffer requirements on top of that, etc. That's all what we call Pillar 1. It's visible to investors and people like me and you. We know, for example, that if a bank has, say, 8% common equity T1 and the requirement is 7%, then there's only 1% headroom for that bank. That's not a lot in current standards. What we don't know is what part of that 1% is required, whether there is an additional requirement from the supervisor to hold more capital than 7%. And in Europe, that can be done through what they call Pillar 2 add-ons or Pillar 2, where the supervisor and the bank agree on holding more capital to cover risks that are not covered for credit risk, market risk, and operational risk. And so the ECB is an example here. The European Central Bank, once every year, they send a letter to the banks that they supervise, and they tell them, it's all fine and hunky-dory that you hold X amount of capital to meet the official requirements, but we think you have more risky assets, and for that, we want you to hold, say, 50 basis points or 100 basis points more Pillar 2 capital. And some countries are more transparent about Pillar 2 requirements, and others are less transparent. The European Central Bank is very transparent about that. They have Pillar 2 requirements that they publish. And so investors can look at that and say, hey, even though the bank meets its formal Pillar 1 requirements, the one that are very known, like 7% for common equity T1 or etc., the additional layer, what we call Pillar 2, is an add-on which should cover most of the other risks.
And Credit Suisse.
Oh, yeah. So the Credit Suisse story is a bit of a funny story, but yeah, they met all the requirements and they had sufficient capital. What they also had is what they call additional Tier 1. And that, the origins of additional Tier 1 bonds is Basel III. Before Basel III, we only had Tier 1 and Tier 2. But after Basel III, or because of Basel III, the regulators decided to have high quality capital, which is the best quality capital of all, which is called common equity T1. But then there was a layer created for pseudo equity, as I call it, and that is additional T1. So you have a layer of T1 consisting of common equity T1 that's very popular and well known. And on top of that, you have additional T1. And these additional T1 items, these are bonds or hybrid capital, which are a bit of a mix between equity and debt. But they, in the case of Credit Suisse, they were bonds. And they are almost like equity, but they also have some characteristics of debt. So this is a mix of equity and debt. And the reason that we have these additional T1 bonds is that they're very popular because the payments on these bonds are tax deductible for European banks. So in Europe, the AT1 bonds are popular because they count towards capital, which is great. And even greater is that they're far less expensive than equity because the payments, the coupons or the interest rates is tax deductible. So there's a big tax advantage on issuing these additional T1 bonds. And the great upside of that also is that they count towards loss absorbing capital. So it's the best of both worlds. And as a result, you see that Credit Suisse and many European banks have issued additional T1 bonds. What people didn't always realize is that these additional T1 bonds are meant to be loss absorbing and going concern, which means that if the bank gets into trouble, the regulator can decide to write them off or convert them into equity, and so the owners will be wiped out. And so the upside of that is that a well-capitalized bank, and there are many well-capitalized banks, can issue these bonds. For the bank, it's tax deductible and advantageous to do so. And the holders of these, or the investors in these bonds, they get a high coupon or high interest rate. So again, here it's the AT1. They have so many fantastic features. They offer the investors a high coupon. The bank gets tax deductibility, and they contribute to loss absorbing capital.
So what can go wrong? We know that.
What could possibly go wrong?
Yeah. So those with Credit Suisse taken over by UBS, those tier 1 bonds, I think, were completely wiped out, went to zero, and that risk, I think people who were in the know, people who read the prospectus, they knew that. But what happened that I think surprised a lot of people is that the tier 1 capital, those bonds, those additional tier 1 capital bonds got wiped out, but the equity didn't get wiped out. And those AT1 bonds were supposed to be on top of the equity. Do you know what happened there?
I think it's very confusing what happened there, and still the FINMA and the authorities in Switzerland, they came out with some explanations about what they were doing and why they were doing. But there's a it been probably can be best characterized as it's been a messy way of resolving or solving the problem that's called the Credit Suisse. The way the authorities went about it was just not great, to put it mildly. If a bank enters a resolution, and that could have been done, in these cases, you start from equity and then you wipe that out, and then you wipe out additional T1 and then Tier 2, and then all the unsecured debt, et cetera, et cetera. So there's a clear ranking in the wipeout in gone concern, or when a bank liquidates or is in resolution. However, Credit Suisse was not really in resolution. It was sold to UBS, and so there's a lot of misunderstanding about actually what was going on here. Was it resolution? No, not really. Was it loss absorption and going concern? So there's a lot of confusion there. But the market was shocked by that, because it was, even though it was written in the text, the expectations of investors were such that the investors expected the wipeout to start from equity and then work your way up to whatever you need to cover the losses, to cover the losses through first equity, then AT1 or additional T1, and then Tier 2, et cetera, et cetera. So that was a shock. And there were a couple of indications before the shock applied that the regulators in Switzerland would respect that, but in the end, they didn't respect the hierarchy. The other thing that's kind of weird is they wiped out the entire 17 billion of additional T1, which is large, but the idea, as I explained at the start, is that capital should absorb losses. And if you go to the accounts from Credit Suisse, you will see that, yes, Credit Suisse had losses, but they had sufficient capital in the first place, so to absorb these losses, and then through equity, and then for the remainder of losses that need to be absorbed, you have to take a look at these additional T1 bonds. But it's kind of a very very greedy in a way from the official, or from the authorities in Switzerland, to wipe out 17 billion of AT1, whereas probably there was no need for that entire amount to be taken down.
So Martin, there's been a widespread view, a mainstream view that I've heard, that yes, banks had a lot of problems in terms of their capital funding. They were undercapitalized 2007, 2008. That's why the global economic crisis occurred. But the regulations, which you, Martin, helped shape and create and implement, because of those regulations, Basel III, banks are much better capitalized. And I know that's a fact, that banks are much better capitalized, mostly all around the world, than they were before crisis. But the argument is, because banks are much more capitalized, there's nothing going to be worried about. We're not going to have these banking issues again. Let's say in 2019, before all this happened, how much did you believe that argument in 2019? agree with that argument? And now that Silicon Valley Bank, Signature Bank, Credit Suisse, now that they have sort of collapsed, how much do you agree with it now?
Well, yes, I mean, correct, because if you look at the spreads of AT1 now, they've gone down. So the shock over the last weeks seems to be abating. It's getting less, when the spreads are going down and things are stabilizing. And the European banking center, the European banking sector held up quite strongly. Whereas I think before the global financial crisis, a failure like an epic failure like the one that we've seen with Credit Suisse would have probably lead to far more serious contagion. So yes, the framework of Basel III and the way Europe implemented it, most likely in full, and many non-US countries implemented Basel III pretty much for all banks, and they implemented it in full, including the whole capital framework, but also liquidity framework and many other tools that Basel III offered. And so you see it at work now, because I think most of the stress is now gone in European banks, and they held up very well. So I agree with that. But the other thing is complacency and stuff that is still not well covered. I think, as I mentioned before, there is still problems with operational risk, which are hard to model and hard to regulate. And this case was, as I said, Credit Suisse was a long story of a lot of operational risks and a slow burn.
And what, Martin, sorry, Professor, what are those operational risks? Can you give us a few examples?
There could be a lot of problems with operational risk. It's just how the bank conducts its operations and what can go wrong there. So things like fraud is one, but fraud can be wide. I mean, it can be accounting fraud. It could be a single person stealing some money. So that's already one. And then money laundering is one. Operational risk, other.
I guess Archegos, banking a client who was taking a lot of risks. Archegos.
Yeah, well, that's operational risk. I think it's just mismanagement, and they were. If you follow the correspondence between Archegos and Credit Suisse, Credit Suisse was kind of waiting for results to come through from Archegos, which then weren't delivered, and so time lapsed. And so there's something in the way the bank organizes these things that is not okay. It's just the maybe the incentive structure, maybe the reward structure, the governance structure. And so to cover that all in a single metric for operational risk is obviously not easy, and that may have contributed, I think, to the demise of Credit Suisse. It's just maybe the authorities in Switzerland were very traditional in that they thought, like, we covered liquidity, we covered credit risk, and we probably have some cover or some idea of how to deal with operational or with market risk. But then the hard part is probably operational risk, and maybe they neglected that part.
Right. So some of the problems in the U.S. banking system, or at some banks, I should say, probably wouldn't have happened if the Federal Reserve hadn't raised interest rates, close to 500 basis points in roughly a year. How is the New Zealand banking system doing, given that it has raised by 525 basis points, over a similar period?
Well, the thing is, with New Zealand banks, is there are, I can't promise anything for the future, but they are amongst the most resilient banks in the world. They have increased the capital ratios, and they will be about close to 20% now, which is very high compared to other countries. So they're
super high,
yeah, they're super high, amongst the highest in the world. They're working towards that. So they started working from a traditional Basel requirement, say in the whereabouts of 10%, but they're moving it up to close to 20% now, which is good. The other thing is the risk weights in New Zealand are such that they don't discount the risk too heavily. Like a worldwide comparison will show that New Zealand banks' risk weights are kind of high compared to other countries. As a result of that, that forces up the amount of capital that New Zealand banks have to hold already. So the New Zealand banking system is super safe and probably one of the safest ones in the world. But yes, the interest rate risk that the question was about, the Reserve Bank, they jacked up the rate by 50 basis points last Wednesday. It came as a bit of a surprise, but then again, the interest rate risk is covered for through derivatives, and so banks are insured against the interest rates risk. So I think banks will manage quite quickly. On the other hand, there will be a bit of a squeeze because the higher interest rates. So what happens is that depositors will demand higher interest rates, and as we've noticed, depositors may have become a bit more easy to move their funds elsewhere. So that puts elevated costs on the funding side of bank, whereas there's competition also in the market for mortgages, and so that may push the net interest margins for New Zealand banks down. So that could be a bit of a slow burn, which may affect the profitability of New Zealand banks in the going forward. So the asset side is a bit squeezed because of competition and because of mainly because of competition, I think, and the funding side will become more expensive because depositors will demand higher rates, and so that will lower the profitability of banks going forward. Then again, the New Zealand banking system is one of the most profitable banking systems also in the world. So their ROE is about 12%, which is high. ROA is also very positive and high, and so therefore our banking system will probably not be affected too much by these higher interest rates. So the trade-off between financial stability and monetary policies are probably not so prevalent here in New Zealand.
Can you explain that interest rate hedging point? So let's say I'm a New Zealand bank, you're a New Zealand bank, RBNZ, Reserve Bank of New Zealand. They raise interest rates. They increase our future profitability when we make loans, and the spread probably will be higher than that spread will go up that more than the deposit rate. So we'll make higher net interest margin. That's good. That's why people say rising interest rates are good for banks. But on our securities, particularly fixed rate, long duration securities that we own, we will suffer losses, realized or unrealized. So we hedge that risk. So let's say I want to hedge that risk. I enter into a swap contract with you where I make money as interest rates go up and you lose money as interest rates go up. But now you have that exposure. It's kind of like a hot potato. I'm passing to you, you're passing to another bank. Where do the losses go? Who is on the other side of that trade who can absorb the loss of?
On the borrowing side of the bank's balance sheet, so their assets, they're swapped, and so these swaps, interest rate swaps, may be taken by small and medium-sized firms and farmers and so forth. The counterparty, the party holding the risks of the swap, on the other hand, my understanding is that it goes to what is the CCPs, so these central clearing institutions that absorb the risk associated with these with the swaps. And it could also be pension funds, which are now increasingly under stress because of that. So I think most of the risks are farmed off balance, and they land elsewhere. And the question is, and that's one of the things that is a bit of unknown, is like with the global financial crisis, nobody realized that most of the risks were absorbed by AIG, or in the end ended up with AIG. And so that, to prevent that from happening, we have the CCPs, which probably manage these risks better than before the crisis. So yeah, somebody will take that risk, but I think the framework has improved in that the risks at the other end of the swaps don't end up with a single insurance company.
And CCP stands for
clearing party, I think.
But central clearing party. So there's the clearing risk, but do those parties also take on the risk of, if I want to enter into a swap where I make money as interest rates rise, they're on the other side? Like they are not just clearing, but they are a counterparty.
Yeah, but my understanding is that these risks then will not affect a single party. So the CCPs, they diversify these risks. But that's kind of technical. Sorry.
Yeah, but if all the banks want to enter into a swap, they're all going to go the same way, right? They're not going to hedge against interest rates going down when interest rates are at zero.
Yeah, but it depends a bit on who's on the other side. And I said, in some cases it will be firms that have a different asset structure, like pension funds. They have long liabilities and short assets, and that matches. So that matches in a way is the counter towards the other parties. So you have to find. So these industries currently, as we've seen, is pension funds are now a bit stressed out because they now are absorbing the risks that of being on the other hand of the swap.
Hey there, sorry to interrupt. A lot of Forward Guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some Forward Guidance listeners are into crypto. Some own crypto. A smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code guidance10. Thanks, and let's get back to the interview. Tell us what happened to Kiwi Bank. I know there was a bank that had some transaction and you wanted to learn this bank was taken over for a certain valuation, and I don't think you received an exactly clear answer. What was Kiwi Bank? What was the transaction? Why was it valued? How it was valued? And tell us that story.
Oh, Kiwi Bank is a traditional New Zealand bank. It hasn't been long. It hasn't been around for very long, a couple of decades maybe, and it was more or less like what we've seen in many other countries, a bank that was half state-owned, half private-owned. It was a smaller bank, one of the smaller banks. With the big four ones are Australian-owned banks, but then the next up is Kiwi Bank, which is bank number 5, and that's a truly New Zealand bank. And there's a bit of a political dimension there because some people in New Zealand find it very comfortable to have a truly New Zealand bank which isn't owned by Australian parent banks. That bank performed okay-ish over the last decade, but what I've noticed is that they were struggling to get their capital up to the higher requirements from the Reserve Bank. So I think I said before that the Reserve Bank increased its capital requirements significantly, and these are phased in over the next 5, 6, 7 years. Kiwi Bank lost capital, or they couldn't get the capital up. And that was clear, I think, after the announcement of these capital requirements in 2019, just before COVID arrived. It was clear that Kiwi Bank would struggle to increase capital because they're not so profitable, they're not so large to make use of all the effects there or all the goodies that comes with size. And so it was decided that the owners, or one of the owners, thought like, this is not a great investment, and they wanted to abandon their investment in Kiwi Bank. So that's not great if the owner wants to walk away from a bank. That's kind of a mini run, not by depositors, but the owners, but yeah. And so a solution was made for Kiwi Bank to have it bought by the state, and it was bought from its 3 owners. One is a large pension fund, the other is a health insurance, state-owned health insurance firm, and the third one was the New Zealand Post. So the 3 owners were bought out by the state in August last year. And to me, it was more like a bailout in that the current situation with the bank was unsustainable in that it couldn't meet the higher requirements. It could only do so by being far more profitable than it was. And it isn't that profitable. It makes profit. Yes, it's not a loss-making bank, but it's not as profitable as the other big 4 banks. The government stepped in, bought the bank, and I tried to figure out what price, actually, why did the government pay $2 billion or 2.1 billion New Zealand dollars for that bank? So in our country, we have a freedom of information or Official Information Act, which allows you to ask the government about these transactions. So I sent an OIA or a request. I think in the US it's FOIA or so.
Yep.
Freedom of So
Information Act. Yeah.
I sent a FOIA request to the Ministry, to the Treasury or the Ministry of Finance, and they said, well, actually, there's no such calculation. We don't. It was agreed between parties. I mean, that had the characteristic of horse trading. Like it's like a nice round number, $2.1 billion. Maybe the idea was to have something between 2 and 2.5. They settled for 2.1. But upon requesting the workings for that calculation or the valuation, send me the spreadsheet or send me your workings, I just got zero answer on that one, which I think is not great because it's taxpayers' money being spent on a bank which is not the most profitable bank. And if you go through the documentation which was released, it seems as though it was a foregone conclusion early on in 2020 that the bank would have been bought by the government anyway. And so it wasn't a lot of work done on trying to find the best solution for the bank, i.e. maybe having it partially floated or having outside investors in it or having other solution. It seems as though from the documentation it was all a foregone conclusion that the state would buy it anyway. We're now half a year later, and I looked at the profitability of Kiwi Bank, and it's still so. So they're going to struggle to survive. I'm not saying that it's a problem bank, but it's still not easy sailing and a challenge for the bank to survive in the future. They'll get there, and it's kind of okay to have it state supported now. It lowers their funding cost, obviously, and the state is willing to prop up capital, but it's kind of not ideal, I think.
What are deposits doing in New Zealand? In America, deposits are going down, and over the past month, there's been a quite significant drain on deposits in small banks, regional banks, and some of that money has gone into big banks, but not enough. So there's been a flood from the general banking sector to money market funds, ultimately leading to the Federal Reserve, and has a reverse repo facility. It's basically a deposit facility. What's that look like in New Zealand?
I don't think that is really a big of an issue. I think depositors here are sticky. The alternatives, I mean, the big four banks, they have a large fraction of the total market, and these are Australian-owned large banks, and there's no reason to believe that Australian banks will get into trouble. Also, again, here, Australian banks supervision is probably equally strong, or if not stronger than New Zealand supervision. So they belong to the Australian New Zealand banking system. They're probably the best supervised banking systems with very solid banks. So I don't think that the public feels that there is any risk that they lose out. Interestingly, there's still not a deposit insurance system in force here in New Zealand. So maybe some people may have become a bit jittery, but then again, the safety of the system is perceived very high. So I don't expect a lot of run. The thing is, I was actually about to look into these numbers, whether there was deposit flight. The problem is the data availability. So I couldn't get my fingers around it, because then you have to look, like in the US, you can look at these call reports and then figure out where money is going from and whether it leaves a single bank. We have a similar system like that. They call it a dashboard from the Reserve Bank, which is quite detailed, but they come out every quarter, and it takes a while before the quarterly information is published. So, ideally, I would like to have the data from the latest data available, but I have to wait a couple of weeks before I get that to give a firm answer on your question. But I don't think there is that much of a risk here.
I want to ask about the risks that you see in the New Zealand banking system of interest rate risk and credit risk. It's my understanding that America is, and I'm American, so I'm always thinking of, looking at things through the lens of America. The real estate boom in America, to Americans, it seems extreme, but it's my understanding that actual housing price appreciation, it can be as much more extreme in places like Canada and Australia. What
Yeah,
is
but also here.
in New Zealand? Okay, okay, that's what I
Yeah.
thought. So is there a risk that if housing prices go down, that banks will be on the hook and that there is credit risk? And I also want to ask, in America, there's a fixed rate mortgages 30 years, and I know in Europe that's
Yeah.
it's a American thing. So if you own if you not if you if banks who make 30-year mortgages, that's more interest rate risk because it's 30
Yeah.
years, it's fixed, as opposed
Yeah.
to if it's a floating rate mortgage, in Italy, it's 5 years, there's much less credit risk. So
Correct.
I want to ask you about interest rate risk and credit risk in New Zealand.
I think credit risk will increase because of house prices are going down now, and the economy is meant to, because of these initiatives of the Reserve Bank jacking up the interest rates, the economy will cool. A lot of people have bought houses in 2000 to 2020 and 21, so there may be a bit of credit risk there. Again, here, New Zealand regulations are such that they stress loan applicants, I think at 8% interest rate before they are allowed to buy a house, at the time. So before banks were allowed to lend to mortgage holders or to homeowners, the homeowners were stressed, or they require at least uh, a borrower to pay about, say, 8%, even if the going rate is way lower. So credit risk may be on the rise, but I don't think it's going to be large numbers. But yeah, some people will feel the squeeze, and the duration of mortgages here is way shorter than in the US. Like in Holland and the US, it's not abnormal to have 30 years, but here I think it's about 5 years and then it stops. Just how the market works here. So yes, there will be some of the mortgages will end their fixed period in the months to come, and they will have to renegotiate, or they have to reset their rates at a higher level. And there's where you see this. There's where you will see the market having an effect on in particular credit risk, interest rate risk.
Thank you, Professor. One of my final questions is about the. I want to ask about the bank regulatory requirements in the U.S. It's my understanding that the President Trump administration rolled back certain regulations on for banks for on stress tests. They lowered the excuse me, they raised the level at which banks would get stress
Yeah.
tests, and then the Federal Reserve and the FDIC. Tell me when that happened, and yeah.
So my understanding was that it happened in 2018 under the Trump administration. They increased the level so that more banks could fly under the radar. I think it was 250 billion total assets or so. So they made it easier for smaller banks to not satisfy the requirements, which and sort of be freed of stress test consequences. And so that probably these regulations will probably be revisited. What I find kind of interesting here is that from the Basel point of view, and if you look at Basel III implementation reports, the US comes across as always be super compliant with Basel III regulations. But it's kind of disturbing because it only applies to the large internationally operating banks in the US. And that is actually the remit of Basel III, where Basel III is only for large and international operating banks. And so, but a lot of smaller banks in the US are just, they don't have to satisfy Basel III requirements. And so it looks like for these banks, nothing has changed since the global financial crisis, which I think is a bit of a worry, because there was a reason why we have Basel III, and you see it at work in Europe now in particular, but also other countries like Australia, New Zealand, where these rules do create a stable banking system. And so the US may be super or maybe fully compliant with Basel III regulation, but on the other hand, there's a vast number of small banks, which in total comprise a lot of or cover a lot of the economy of the US, which are more or less on the same regulatory footing as they were 15 years ago. That to me is a bit of a worry. And I can see why commentators and pundits identify that worry as well.
Yes, and a lot of those smaller regional banks punch up, they make a disproportionate amount of loans to commercial real estate. So,
Exactly. Yeah, which we all know is very risky. So you have high risk and you have low regulation. So what could possibly go wrong? It's tricky in a way. But then again, let's see how it goes. But there is a bit of an issue there, I think, that the US may have to solve going forward. But that's time will tell, I think.
Yes. Well, Professor, it's been a privilege getting to hear your insights. As you can tell, I don't know a lot about bank regulatory capital, and I feel like a lot of people don't. It's a very complex issue. Could you just summarize for us how you see things playing out, and how bank regulatory capital requirements play a role in that?
To be honest, I think there's not going to be a lot of changes with respect to capital requirements. They're high, and there's a lot of tools in the toolkit that can still be used and that have not been used. So my reference just back to the US system is that the Basel III toolkit is available, and yet the US decided not to apply all the tools to the US banks, and there may be good reasons for that. So I'm not being normative here and telling you what a country should do, but there are many tools in the regulatory toolkit that can be used. So I don't think that the Basel Committee is going to change a lot based on what it sees now. It's a very stable and predictable global regulator where they cover the interests of, I think, 25 countries. And this was kind of, if you look at the shock, Switzerland is a Basel member, yes, and the US is a Basel member, but they were kind of localized shocks. I think that is insufficient to move and to change a lot with respect to the Basel III framework. So my suggestion, or what I predict, is that countries may make more use of the tools offered by Basel III. And I think there will be a more focused on the liquidity dimension here. I think most regulators were surprised with the swiftness and the speed with which depositors are able today to flee to safer harbors. I think that caught many people by surprise. So we may see some changes over time with respect to the rules on liquidity.
Yes, and Professor, people could find your work on Twitter. You are at Ketir1, and your blog, Capital Issues.
That's it. Correct. Capitalissues.co, not com, like your website, I think. Also with a co instead of a com.
Yeah, Blockworks, yeah.
And my Twitter handle is CTA1, which is Common Equity Tier 1. Yes.
There we go. Well, Professor, thank you so much for sharing your insights, and thank you everyone for watching.
Thank you very much. It was a pleasant.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro, or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.